Just before we start, I'd be really interested to have some idea of who we've got in the room here today. I'm glad we've got someone in the room. You never know at these events. So how many people in here are practice owners? Okay, that's interesting. How many people working in practice but non-owners, so associates or assistants? Practice managers? Yeah. Vet nurses? Accountants? Thank goodness for that. That was the one I was worried about. I'm not an accountant, as you can see on the screen. I'm Josh Belgrave. I'm a veterinary surgeon. The first part of my career I spent building up a large equine hospital. I was the managing partner at Arundel Equine Hospital, so I know nothing about cats and dogs. But I do have some experience of trying to build veterinary practices, which I think is probably relevant to today. And after doing a number of things, I'm currently the CEO at Hallmarq, so I'm very involved in capital equipment purchases, which is why when I was talking to Rob Chapman, who runs this wonderful show, we came up with this idea for a talk today. So I hope you find it enjoyable and learn something. This is what I'm going to cover today. I want to talk a little bit about the business environment in which you make these decisions, because I think that's important. I think we have a habit sometimes. I think if you're going to stereotype the veterinary profession, we're very reactive individuals and we're not very strategic individuals. I would count myself in that group. So being a little bit strategic, look at business environment, talk about what I call the total cost of ownership. And when I talk to practices, a lot of what I do now is talking to practices around the world in many countries and getting them to really think through what the total cost is when they're buying a piece of equipment, not just look at what the Americans would call the sticker price. And then I'm actually going to do a worked example through how I would approach building it up. There's no unique way of doing it, but I'll show you how I would work through building it up. Using a spreadsheet, and if at the end of it anyone's interested in actually having a live copy of that spreadsheet, my email will be on the last slide, or give me a business card or something. How many vets in the room here have got business cards on them today? Well done. Always a minority. Very useful tool to have, guys. And I want to talk a little bit about pricing, because obviously there's a relationship between what you can afford and what you can charge. So I'll bring that in later on. Let's take my watch off to make sure I don't run out of time. Vets love toys. I mean, that's the beginning of it and the end of it, really. I used to be an equine surgeon. I've done my share of toy buying as well. And at a show like this, you're just deluged with opportunities to empty your wallet. And you know, I'm in the imaging world now, so these are the kind of toys that I'm often talking to people about, not so much ultrasound, but expensive pieces of equipment. And for the purpose of this discussion, I'm probably going to pick on CT as an example toy, or very useful profit center, if you want to look at it that way. As we go through. But what I've noticed through my career, which has run on a little bit now, is the way the capital equipment has sort of cascaded down. You know, when I was at vet school, which was a long time ago, really the vet schools had all the expensive stuff because they had capital grants from the government or someone to buy it. That then moved out into private referral practices, which has been a big growth over the last 10 years and actually probably even the last 2 or 3 years in this country. Last 10 years in the US. There are 650 specialty practices in the US now. And now I see it starting to cascade into the larger first opinion practices as well, these significant capital expenditure purchases. But the logic of what I'm discussing today could apply to a £10,000 ultrasound machine as well. It doesn't have to be a very expensive piece of kit. What I'm going to try and do, I hope, is share with you the methodology that I think is useful for making your business decisions. And the first thing, as I alluded to, is I think you need to be a little bit strategic. You know, there's a lot of change going on in our industry at the moment, a lot of shift, the corporates coming in, a lot of people, the predominant group in the room were practice owners who no doubt are trying to work out how they compete in the environment they're now facing, some very interesting challenges. I think there's some great opportunities to compete with the corporates, and I think there's some good things the corporates bring to our industry. So, but you need to work out where do you sit in that value chain. There's no point going out and buying a piece of equipment because you got excited about it if it doesn't fit the strategy you're trying to pursue as a veterinary clinic. So please, before you sign the check or even get too excited at a show like this, is work out what you're trying to achieve as your practice. Strategy is a grand name. It comes down to common sense usually. What's the equipment I need? Is it compatible with what I'm trying to achieve as a practice? And even doing a little bit of market research, which once again Alison does excellently on a very professional level, but I always think market research is common sense. It's just sit down and ask yourself the right questions before you dive into whatever you're planning to do. And really, you should do that before you come to the event like this, which then gives you a framework within which to look around what's on the floor. You can't look at everything here, it's just mind-boggling. And you need to know what not to look at and what to look at, so your time is well spent. So try and do this before you come. And what's the demand for the servicing area? What's the pricing? What's the local pricing? Doesn't mean you have to mirror that pricing, but it's good to know what's being charged in the area. And importantly, is that price sufficient to make you profitable? Because it's really usually not a healthy situation to buy a piece of equipment that you know you're just going to lose money on. Break even maybe, because it has other benefits, but losing money can end up being a millstone if you're not careful. Who else is competing? Very importantly, are we as a team, are we skilled enough to use this? Have we got the right surgical or clinical context to use this equipment? So use your common sense. Market research is nothing other than is common sense aggregated on a large scale, is the way I look at it, asking lots of people's opinion. So do your research, and also how can you differentiate? And I think with the corporates coming in, there are lots of opportunities to differentiate your service, and you need to focus and work out what you think that is. And so I think the corporates have a very positive impact on the profession, if only because it makes the rest of us sit up and look at what we're doing. So to look at the calculations, this is a very basic slide because it's a simple question. So what is the calculation? Well, how much can I charge? How many can I do? How much does it cost? And the difference is your profit and loss. So at one level, that's a really simplistic statement. But then if you dive into it, and think about it, so what can you charge? What is the right amount to charge? And we'll talk a little bit about the pricing. How many procedures? It's really hard to predict how many procedures you'll do for a piece of equipment you don't have. I don't have a magic answer to that, but you have to try and work out, jot down the number you refer, whatever. But it's probably the hardest thing to work out in all of this. And I've underlined the total cost of ownership, and that's what I'm going to go on and talk about now, because I think getting that clear in your head as to what is that total cost is important. And hopefully you end up with a profit, not a loss. So this slide's a little bit busy. I apologize for that. I don't like slides with too much on them. But it sets the framework for the way. It's very difficult to work on a spreadsheet on a screen this size. So what I've done is I've cut my spreadsheet into chunks. I'll show you the whole thing at the end in tiny print, which you won't be able to read, and I'm very happy to share it with people. But these are the kind of headings I'm going to work our way through. So if you just sort of take note of the concept behind it. I'm going to look at the initial costs of installation. Once again, my example is a CT machine. I've roughly used guesstimate prices for CT. So what's the initial cost? How are you going to finance that? Thinking about the depreciation, which is something that many people I talk to forget to work into their model. Looking at your fixed costs, variable costs, how much money you're going to make. What I call the gross margin, I find slightly different definitions around for gross margin, but for me it's my revenue minus my variable cost. And then we get to the interesting stuff, which is where's the break even, what's the profit, and what's the cash flow, which I hope to spend a bit of time on towards the end, because that's what we're trying to get to. But you have to build up the first steps before you can look at the bottom step. And the value of doing this in a methodical way and on a spreadsheet is you can then flex it and look at hypotheses. My view, running a company as I do, is the most useful value of these spreadsheets is to put what-ifs in there and see what on earth happens. And you start to learn the financial dynamic and the relationship. And I do a bit of that. And so just to make it more interesting and possibly more complex, as well as looking at building up those elements in the spreadsheet, I want to look at 3 different ways you might choose to finance the system, because that's another choice you've got to make. I'll look at an outright cash purchase, assuming you've got a lot of money in the bank or whatever the situation is. I'll look at lease purchase or a bank loan, because they work roughly similarly in terms of the way that the calculation works. So basically borrowed money on which you're paying interest. And then we'll look at a pay-as-you-go model, because I think that's also interesting. And that happens to be the one that I'm very familiar with at Hallmarq. So to start at the top, let's get a pen. So this is the first section, the initial cost section that I would start looking at. This is the kind of thing that faces you at the show, and some people sort of get to this line and stop in their mental arithmetic. But you've got a capital cost, and 150 is probably a higher-end CT machine. You may need to build a building or refurb a room. You've got some costs in there, 25. I don't know if that's the right number, but these are placeholder numbers for now, and if you do have the spreadsheet, you can put whatever numbers in there you like, and you'll see how it flows through. You've got to get trained on it. Sometimes you get that wrapped into the purchase price, sometimes you don't, but don't forget there's a training cost, because Having this machinery, getting trained on it is incredibly important because that's also what drives your profit. Something I come across quite frequently, particularly with the higher end imaging stuff, is that people find they don't have enough power available. You know, CTs and MRIs and things take quite a lot of juice, and often if you've already got quite a few of these toys in your clinic, you might have maxed out your available power supply. It's particularly an issue I see in practices that are in sort of semi-rural kind of old farm converted into business park settings. They tend to have quite poor power supply, and that is what it costs to get your power upgraded. I know 2 clinics that have spent $15,000 getting a cable laid across a field for 2 miles, and it also takes 6 to 8 months. So power is a real issue. So you need to do the calculation to see what kind of power extra you have. Obviously, in the pay-as-you-go model, you're not owning the machine, so there's no equipment cost at the beginning. The pay-as-you-go model, the company you're working with owns the machine, and you pay every time you use it. But you've still got the other costs because you've got to get it installed and set up. So that's giving us a total investment cost at the beginning across the 3 different ways. Okay so far? So now I'm going to take that investment cost and I'm going to work out how I'm going to pay for it. And obviously that's very different across the 3 different routes. So I've assumed that my project period is 5 years. A lot of this machinery lasts more than 5 years, but that's what I'm working with in the model today. And I've made a guess at an interest rate of 5%. You know, you'll probably be paying often a bit more than that. If you're lucky, you might get a bit less. Depends what the route is, whether it's bank or lease purchase. So then take that, so I'm taking these numbers and applying that period of time and that interest rate to it, and coming up with my interest cost. Obviously, it's a cash purchase. One could sit here and debate whether there's really a 0 cost of interest on cash purchase. My personal view is there's no free money in the world, but you don't get much by leaving it in the bank at the moment, so it's almost free. But anyway, I put a 0 there. You could argue that if you want to. And then here's the bank loan, and these are different because you've got a different amount of capital you're paying for. This is where I put the equipment depreciation. You'll see it appear again later on. Look at my equipment depreciation. So I've assumed, once again, the machinery has been depreciated over 5 years in a straight line. You may have a different policy. That varies from practice to practice, but that's my assumption here. And obviously, if you're on a pay-as-you-go, you don't own the machine, you don't have to depreciate it on your books. Depreciation on the other costs, that was the sort of installation, training, building costs. And once again, different practices have different principles. I've assumed it's 5 years. So it's the same for everything. But you start to see here how even with one piece of equipment that's got a value of 150,000, we're starting to get quite significant differences in the way the model works for different ways of purchasing. So then taking that number, folding it down the page, as it were, I'm then looking at the fixed cost, and I'm bringing down that finance cost that we just, so once go back up. So the bottom line there is being brought down into my monthly fixed cost. This is what you've got to pay out, even if you don't do a single examination or procedure in the month. Fixed costs, they are what they say they are. Finance costs are a significant one. The power you use, some machines, even if you don't use them, draw power. So I put that into the fixed costs. There is a slight variation with how many sequences you run, but keep life simple, just put it in the fixed costs as far as I'm concerned, average it out, put it in the fixed costs. So an important thing to ask your vendors on this higher end machinery is what is the monthly power cost going to be? Because they vary quite a lot. And then assuming you take a support and maintenance contract, that's a £20,000 a year support and maintenance contract spread over the 12 months. I work everything on a monthly basis, by the way, just in case I haven't been really clear. This is all monthly. I just find that the easiest period of time to look at. A week's too short and a year's too long for me, so I do everything on a monthly basis. So that's given me my total fixed costs. And to some extent, that's also a sort of risk factor that you need to take into account, because you're going to pay out this money whether or not you do a single scan, CT scan, procedure, whatever it might be. So that's your total fixed costs. And the different routes have different risks attached to them, and you need to decide which one you're happiest with in that. Because what I'm going to drive to is where that break-even point is. Because to me, I find that the easiest number to start with is how many procedures do I need to do to break even? And we'll get there at the end, so just bear with me as we go down the list. So we've done the fixed costs, now we'll look at the variable costs. So these are the costs that change with the volume of examinations you're doing. And You've got a vet nurse's time in here. You've got the vet's time in here, whether it's reading images or doing the procedure. Once again, these numbers are slightly placeholders. You can easily play with them and put in what you think is appropriate. But even though this is a vet on a salary, and therefore there's no real cost, my view is you should put a cost into your business model of that person's time for that procedure. It's a very realistic way of looking at it. You've got some drugs and fluids and consumables, whatever it is. Those are the same for all the models, but if you want to pay as you go, you're probably going to pay a fee for every time you use the system. That fee will vary, but I put £75 in as an example fee here. So effectively, if you multiply up this fee, that over time is what pays the capital cost of the equipment. So it's kind of a trade-off between those two. And so that's giving us variable costs. And you'll notice, once again, you've got quite a difference here. So this is where spreadsheets are so useful, because they can, at the end, they'll bring this all together into some coherent numbers. So that's just to try and help us take stock of where we've got to. We're down here. We've done the ones in grey, so we just looked at variable. And to some extent, this is the homework. This is the unexciting part. I think we're now getting into the piece that I find really interesting in practice. I didn't know when I started as a vet that I would find numbers interesting, but I do, which is kind of scary. And trying to understand how this turns into a business and does your business work. And so we look at revenue, the gross margin, and get to the key things at the end here. Everyone okay so far? Haven't managed to lose you? One question, yes? I can't quite hear. Pay as you go. Pay as you go is a model that's increasingly common in the market. It's still unusual, but it's growing, which is that you don't own the machinery, but you pay every time you use it. So every time you do a scan, or every time you do an x-ray, or every time you do... So the company that you work with owns it, and you just pay to use it. And it's less common in our industry, but it's become very common in some other industries, where you're effectively outsourcing the ownership of the equipment. Question?
How did you work out your staff variable costs when you don't know, when you haven't put in the number of exams yet? Or how did you
This is per... It's a good question. This is per examination. This is per examination. Sorry, I didn't make that clear. So this is me estimating. To be honest, I don't know what vet nurses get paid these days. I don't think there are any of them in the room, so I'm not embarrassing anyone. But I assume this was maybe an hour or 2 hours of a vet nurse's time. I know that's roughly what radiologists charge to read a set of images. That's why I put that. But this is per examination, so that's a really good point. Thank you very much. We're going to multiply it up later on. Okay, so let's look at the revenue. And I've assumed that we're going to charge our customer £500, excluding VAT. And that's the same for all of them. So that gives us a gross margin, which, as I said, for me, is the revenue less the variable cost. And that varies, once again, for the different ones. And I've brought down from higher up, if you can remember, higher up in the spreadsheet, we looked at the total fixed costs. And just because it's easier to present it this way, I've just repeated that line down here so you can see it. Because what I'm trying to get to, and I just find this the most useful number when I'm talking to people and to understanding, is how many cases do I have to do each month to break even? Because some vets say to me, look, we think this will add value to the practice, and as long as we're breaking even, we'll do more surgery, or we'll do more something else, or we'll differentiate ourselves from some other practice down the road. That's a perfectly valid business decision. You could decide you were willing to lose money. As long as you know how much you're losing, and you're still happy, I wouldn't argue with that. So getting to this number of examinations, this is per month again, just to reiterate, I'm always on a monthly basis. And the way you get to your break-even is you take your gross margin. This is the fixed cost that I have to pay every month. So even if I don't do any examinations. So the maths, and if you get the spreadsheet, you'll see it in the cell on the formula, is you just, how many times do you divide, how many 340s do I need to cover my 5217? That's what the sum is, because then I'm back to zero. I've used up all my gross margin to pay my fixed costs. I've broken even. But what's important to me is I've broken even on a fully comprehensive model, and I've not just looked at the equipment cost, I built a proper business model for this. And what's interesting, this is where it all comes together, is how variable the answer can be. Now, obviously, it depends on the interest rate, or it depends on the fee per scan, but whatever you're paying for, what I can guarantee to you is you will get significantly different answers for the different ways of financing your capital purchase. And so that's why you need to look at it and work out which one suits you. You know, and if you're being charged a high fee per scan and you've got lots of spare cash in the bank, you may find this becomes more attractive. I don't mind which one it is, but I just want you to work it out and to be clear which one it is. And it's incredible how few practices ever can tell me the answer to that question. And it's also something that's quite easy to judge clinically. I think that's why I like it. You can bridge across and you say, okay, so I've got to do 15 a month, you know, here, so 16, so 4 a week. You know, you can quite quickly get a feel for that in your clinical setting without doing any complicated, you know, you can also look at your records and see how many you've done, but, you know, it's just easy to get a handle on it, is what I find. So to me, this is a really, really useful number to focus on. And what also is interesting is how this number changes if you flex the pricing. So I said I'd talk a bit about pricing here as well, because I think that we as vets, certainly when I was running a practice, I think we were very bad at pricing. I wouldn't want to comment whether that's changed a lot, but you either found what everyone else was charging and charged the same, or you had a guess. But what I want to do is I'm going to flex this number, and I want you to watch and see how this changes down here. In fact, I've done it all on one slide because I couldn't think of any other way to present it. So it says 500 there, but what I did is I flexed the model and I charged 400, 500 and 600 for the same procedure, just to see what happened. And look how the difference is in the number of scans I've got to do to break even. Really very significant. And what's interesting about it is that I've gone down to 400, so I've got a 20% reduction in my revenue, and I've got about a 40% requirement in my increased volume to stand back to where I was before. And you know, I would criticize us as a profession. We're very bad at understanding that dynamic. And the number of times I see people who say, well, I cut my prices and my volume went from 15 to 18, say. And they're really pleased. They're doing 3 or 4 more a month. I said, yeah, but you're just losing more money. And they look at you kind of blankly. How can it be? I'm doing, you know. Are there any academics in the room, by the way, from vet schools? Great. Vet schools are absolutely useless at working this out. And I've had many arguments with deans and finance people at vet schools trying to show them that they're just working their radiologists harder and making less money, but they've got more cases. They say they need them for teaching. That's the usual answer. So it's really interesting. The ratio of the switch here is actually very similar across all the different ways of buying. It doesn't seem to change much with the route you financed it. But this is why I think spreadsheets are good, because you can sit there and you can change this number, you can play with it. You say, well, what if we said we're a really high quality practice, we only want the best customers, we're going to charge 600. Well, all of a sudden, you know, that might make the difference. So also buying higher end equipment, you might feel you can justify, you know, in the MRI world, there's low field and there's high field, and actually they get charged out at roughly the same, which seems kind of strange because the cost base is very different. So, you know, it might justify the kind of equipment you choose to buy because you think you can sell it better. Selling isn't the word that vets always like, but sell it better, ethically. You know, there's ethical selling. So I think that's really interesting to see the way those numbers vary. So I'm just going to look now. I think we're doing all right for time at the moment. Profitability. Now, this is, you know, profitability is important. We all want to run profitable businesses. You know, I may be teaching you guys to suck eggs, but don't forget the difference between your profit and your cash flow. Once again, I find that's an area that people get very confused about. This is what your accounts will look like, but it's not what your bank account will look like. I'll show you what the bank account looks like in a minute, because once again, they're radically different. You know, accountants have their own black magic, and particularly when you're buying big bits of equipment, you've got depreciation in there, and depreciation is not really a cash item on an ongoing basis. You pay for it once, but it appears in your accounts going forwards as a depreciation. And you know, that's an area I find people don't quite think through adequately. So this is a profitability analysis. I've assumed, this comes back to your point over there, I'm now multiplying up the volume of cases I'm doing and working out what my revenue is, and based on the fixed and the variables, multiplying up my variable, adding the fixed, that's my cost, and here's my profitability. And once again, what's interesting is you get different answers. Same piece of machinery, same amount of work, same number of hours in the day you've sweated over it. Reasonably significant differences in profitability. I don't claim these numbers are absolutely the ones you'll get, but the concept is there, and you can plug in whatever numbers you like and scare yourself or not as to whether you can go ahead and do it. If you've just bought it, might be a wake-up. So very different results in profitability. But to some extent, this is a little bit theoretical because this is what the accountants do, and what you have in the bank is in some ways more important. Certainly the first criteria is to make sure you're cash positive, and the second one is to be profitable on a P&L basis. And by the way, just going back to P&L, quick disclaimer, this is pre-tax. I decided not to try and get into the taxation situation. There are some slightly different impacts on taxation on how you buy this equipment, but taxation varies from one clinic to another. If you've got some losses to carry forward, your accountant will have to do the final step, if you want them to, is to show them that number and ask them to do an after-tax calculation for you, because they can vary between the different ways of purchasing again. But I decided to stop at that point because you get into the black arts of accountants and capital allowances, which I never quite get my head around. So now what I've done here is a cash flow. So this is some would say the more real world than a P&L, but you've got to make sure your cash flow works. And just to run through things in red and negative, fairly sort of typical way of doing it. So year one, this block here is all year one, because obviously that's when a lot of the cash is moving around with some of these business models. So I've capital costs, so that's a combination of all the costs we had. That's buying the equipment and building the room and installing it and all the rest of it. So that's money you paid out because you were very wealthy and it was in your bank account, so it went out the door that day. This is your trading cash inflow, and this is one of the ones that took me a long time to understand, but that's taking your profit from the previous line here and adding back the depreciation that you had further up, because I said depreciation is an accountant's device. It's not real money, it's an accounting device to spread the cost of something over the year. So to get to the cash, you take your profit and you add back the depreciation that your accountants messed around with. And you can have all kinds of depreciation policies. You can depreciate 10 years, 5 years, you have some discretion over that. Don't depreciate over longer than the lifetime of the system though. So in this case, in year one, if you bought it for cash out of your bank account, you're well out of pocket, not surprisingly. With a bank loan, that's your net position on cash, and with a pay-as-you-go, that's your net position on cash. And then if you take the 5-year model, so you need to be aware of the year one, mainly because there's this big negative here if you're buying it for cash. And you can't spend cash twice. Once you've spent it, you've spent it. We all like thinking of ways we can spend that sort of year-end bonus in many ways. Once you've spent it, you've spent it. So you can't spend that on anything else. You could buy quite a nice boat for that, actually. But this is over the 5 years. So over the course of this project we've run with this piece of equipment, this is the cash impact. Fortunately, it's all inflow. There's no outflow, so that's good news because we got the pricing right and we paid the right amount and the model works. But interestingly, quite significant differences of cash inflow between the different ways of financing it. And you can probably start to see why pay-as-you-go in other industries is becoming quite popular. A lot of big businesses just outsourcing bits of their business to someone else to run, and they pay them on a monthly and on a regular basis. Because once you start looking at depreciation and cash flow and things, it's got a lot of attractions. And it leaves the issue of capitalization with the partner, the company partner you're working with. Just to keep, there aren't any accountants in the office, in the office, shows where I work most of the time, in the room today, but this is assuming that everyone pays and you pay everyone on the same day. Just mathematically, it's easier. It never happens. So once again, if you were doing, there's probably a weakness in this model, thinking back, you should take account of the fact you get paid later, I won't say how much, or you pay earlier. It's a question. I missed the beginning of the question. Was it how? If I change the price, how does this vary?
On this particular model, you're not changing your price over the 5 years.
No.
Over a longer period. And also not discounting future cash flows and things like that.
Yeah.
Is that just simple or just...
Yeah, I mean, two questions in there in case you didn't hear. One was a very good point. I've just taken the £500 over the next 5 years. My pricing hasn't changed in 5 years in the model, which is correct. Sitting here today with inflation at 0, that might be the right answer, but 5 years, I don't know. You could model that in, it gets much more complex, but you could model your pricing in and change your trading cash inflow. You'd have to have another dimension, but it's mathematically fairly easy to do. You say, well, let's say 2%, just do a compound 2% on your 500. So you could, the way I would do that is I'd probably set another tab on my spreadsheet and do my pricing on another tab and bring the total back. And And the second part of the question was looking at future cash flows and discounting them back to today. I think that was your question, wasn't it? Which is another concept that once again is not widely understood, but £5 today is probably worth more than £5 in 5 years' time. That's fundamentally the question. And so there's a calculation, and if you do Excel, there's the calculation in there you can do called a net present value. And so it says, well, £5 today is worth £4.87. Sorry, £5 in 5 years is worth £4.87 today. It's called a net present value, or an NPV calculation. And the gentleman's quite right that if you're really going to get deep into this, you should look at the NPV calculation as well, overlaid on it. But it could be added in, and once again, there's a formula in Excel that help you work it out. But I haven't done it here. I've just taken present days in the straight linear stuff. But it's a good point. It's a very, very relevant point, particularly in longer term. If you're talking 10 years, then the net present value will be significantly different. So, just about at the end, I think timing is going quite well. This is why I had to break the spreadsheet down, because it doesn't kind of work if you put the whole thing on the screen. But you can sort of get a drift. You know, here was our initial costs. Here's the number of years, which gave me the monthly costs of the money, finance costs. Here are the fixed. Here's the variable block we looked at. Here's the fee to the customer, so you can plug in different numbers here. I mean, it should be the same number for all of them, but you can vary the 500. Break even in red, because to me that's the one I'm really shooting for. And the whole of that. And I say I'm very happy to send out that spreadsheet if you either email me at that address, or the few of you that have a business card can leave me their business card, and I'll send that out to you. Yeah, do. The microphone would be good.
So obviously after 5 years, then everything changes significantly, because if it's still working after 5 years, then
what you have to. I think the question was heard. At the end of 5 years, everything changes. Is correct, assuming that if your equipment has a lifespan that goes beyond 5 years, it would change, and you'd need to. You could run the model as a 10-year model if you wish to, but my personal preference when I was running a practice was to try and pay for it in 5 and hope it lasted a bit longer, and then if you get 2 years at the end at a different price, that's fine. But I didn't like to make my calculations on that basis. But you're quite right that after 5 years, this calculation would shift. But you could take this model.
Because the pay-as-you-go is...
The pay-as-you-go would the longer it goes, it might become more expensive. There'll be a switchover point, and that'd be very interesting to model. Is, you know, if you get to 8 years, which is the better one? If you get to 10 years, which is the better one? So you could definitely extend this across that way. It would be a good exercise to do.
And you not sort of take into account any resale value that you might, if you own a piece of equipment, you might?
Yeah, resale value is usually much less than you hope for. So once again, my approach to these things, because I tend to think, is I would put a 0, and if I got something, I'd be really pleased, and I'd go on holiday or whatever it was. You know, that's just the way I approach life. Is write it off, forget about it, assume it's 0, which is what the model does. You're quite right. The model's assumed it's 0 at the end, and there's no run on. If you get those, they're nice sort of bonuses, but they're two good points.
And are you saying that? I mean, I know it's different depending on obviously it'll change depending on the cost of the equipment and all the variables, but pay as you go, are you saying that generally is a better finance option? I
think it depends. I mean, it will vary, and this is an example that you plug numbers in. You need to plug the numbers in and make sure the key driver in a pay-as-you-go is what you're paying per scan. So you need to make sure the numbers work, and that it's as straightforward as that. You know, I'm biased because I happen to think the pay-as-you-go model is a really interesting one. It's one that wasn't around when I was in practice, and I think it has a lot to commend it. But I'm not here to try and sell particular models. Plug the numbers in, make sure you're paying the right amount, and that it stacks up between the two. But I think the key takeaway is please do the numbers, because you know, I could argue make my life a lot easier with trying to persuade people if they don't understand the numbers sometimes. But you know, do the numbers, because you will find different answers, and your situation will vary, and your appetite for risk will vary, and these have different risk profiles in them. So just make sure you run the numbers, and then you can have a more coherent conversation with whoever's supplying you down whichever route it is. Oh, one over there. You could just wait for the microphone. It'd be much easier for all of us, I think.
Thank you.
Just thinking on your revenue per, or your revenue per procedure and the costs associated with that, and you put in staff time, but obviously in small animal, a lot of things we do also involves, you know, premises, staff, anaesthesia equipment, anaesthetic costs. Do you just work off your normal P&Ls to give yourself a rough estimate of those costs per procedure, or do you limit it to solely the revenue from using the piece of equipment and not from your other areas?
No, it's good. It's a good question. Yeah, do you just sort of keep this as a kind of slightly artificial box around this procedure, or do you factor in lots of other bits? I think my answer to that would be, at some point you have to keep life reasonably simple. But where I talked about a profit, actually, I should have changed that. That's actually a profit contribution, is the right word. That's how I would respond to that situation. So you have a kind of general overhead, because you've got a receptionist taking the call, you've got a corporate or a practice overhead. And so really, when I said you've got a profit at the end, to me that's a profit contribution, and that 2,000 or 3,000 a month, you could then ascribe a corporate overhead. This is where the big companies would do it. They'd ascribe to this procedure, in a slightly arbitrary fashion, I have to say, they would probably ascribe £500 a month as a corporate overhead that would pay for the anaesthetic machine, or the receptionist, or the booking system, or the back office IT system, all that kind of stuff. The PACS system, if you're in imaging, you can't image without, you know. So that's how I would deal with it.
Okay,
is think of it as a profit contribution, which I should have changed on the slides. That's a really good point. Anything else? Lunchtime, all done. They say at the auction, hammers going down. Great, thank you very much for coming today.